Thanks for joining us today for Jennifer Schaus and Associates and our Webinar Wednesday program, coming to you live from Washington, D.C. We're uncovering each part of the DFARS, or Defense Federal Acquisition Regulation Supplement, every Wednesday at 12 p.m. Eastern. And as you know, the DFARS are the rule books for contracting with the Defense Department. And we have been moving sequentially, so we started with DFARS Part 201 in January, and we will be finishing with Part 253 in December. Our webinars are every Wednesday and are provided complimentary. They are recorded and can be downloaded from our website and YouTube channel, which now holds over 450 of our government contracting webinars. And in the interest of time, we do not take questions, so if you do have questions for our speaker, we will have his information on two of the slides in the presentation today. Virginia PTAC at GMU offers free one-on-one counseling to firms in Virginia on federal, state, and local procurement topics. Online resources and group trainings are free with no restriction on business location. If you are interested in learning more, please use the links provided to explore what PTAC can offer. Set Aside Alert provides up-to-date news, information, and opportunities for small business federal contractors. Their daily opportunities alerts assure you won't miss important sources sought in solicitation announcements, providing details so you can jump on the hot ones. Every 2 weeks, they deliver concise breaking news, events, regulations, and teaming opportunities. And please join the Reston Chamber of Commerce Government Contractors Council for regular meetings. You can contact Alicia Fields with the email shown on your screen if you have any questions. Federal contracting is a relationship game. Now get in front of your federal human sooner with the exclusive Players and Layers method from Judy Bratt and Summit Insight. Connect with her on LinkedIn and find out more, or visit growfedbiz.com today. Okay, and now a little bit about us. We work with U.S. federal government contractors, including product, service, and software firms. Our services range from market analysis reports to contract vehicles and compliance, and more information can be found on our website. We also have opportunities for your organization to advertise in our newsletter. We now reach over 23,000 subscribers, and this includes both contractors and government. Contact us for pricing information with the email shown on your screen. I also wanted to inform you of a new series that we're holding this year. We have launched a monthly series called the GovCon Live Q&A Cafe, and this is a live webinar series held each month. These take place on the second Friday of each month in 2021 at 12 p.m. Eastern, and we have assembled a group of 4 panelists who are subject matter experts on a specific federal contracting topic. The panelists will make a short presentation about the topics listed here on your screen, and then take your live questions about that topic. So, for example, we covered proposal writing last week, and next month, on August 13th, our panelists will be covering compliance. Our panelists include attorneys, consultants, and other industry professionals, and you can sign up on our website under the Q&A Cafe tab. Sponsorships are available for these webinars. Please email hello@jenniferschaus.com for a media kit with pricing details. Also, please note that you can use code DFARS for a $15 discount on each of these webinars. Okay, and now to introduce our speaker, Robert Gutierrez. Welcome, Robert. We are glad to have you here with us today, and I'll now turn the floor over to you.
Thank you, Hunter. You can move to slide 1. So we're going to talk a little bit about DFARS Part 230. It's very, very short. So we're also including some information on cost accounting standards and FAR and the relationship. So if you are going to use DFARS 230, you'll have a background on what you're trying to waive. Next slide. So we'll start off with the actual subpart 230.2 waiver section of DFARS. We'll go into a little bit why we have CAS, or the cost accounting standards. Discuss a little bit of CAS and FAR, how FAR pulls in a little bit of CAS. So you may be subject to CAS even though you may not have known it just by the fact you have to use FAR. We'll get into the modified CAS standards, so 401, 402, 405, and 406. And we'll see a little later that's why this is important, just to kind of focus on those as well. Next slide. So here's the first part of the waiver. This is DFARS. It's basically the military departments, Army, Navy, Air Force, Marines, and the director of the Defense Procurement Acquisition Policy Office that can grant these waivers. So these waivers aren't granted by your typical contracting officer. They go all the way to the top, so to speak, all the way to the top policy person. There's two instances that FAR has for a waiver, and CAS, or DFARS has incorporated this. But you can get a CAS waiver if you meet the conditions in FAR 30.2015B1, which if you go to that regulation, you'll see that there's a condition that the contract be less than $15 million. So you're not talking very large contracts, but enough to subject you to CAS. Primarily, the contractors engage in the sale of commercial items. So it's usually the first time a typically commercial company has waded into the waters of a more negotiated contract, a more flexible contract, something other than just buying something off the shelf. And you also have to have no CAS covered contract. So it's basically for brand new. The other exception has to do with how urgent or how necessary does the agency need what they're buying. So the CAS waiver may be granted if there's very exceptional circumstances where there's an agency need. So if you think overall, it could be, like a hurricane or a storm or something, you've got to get certain special, maybe equipment to a spot very quickly, and you need all the suppliers possible, and so you may grab somebody who's not used to doing government contracting, and maybe CAS waivers come into play. Since this is DFARS, I think on the defense side of having to deploy assets very quickly or in exigent manner, so that you may be pulling suppliers who are just not typically in that government contracting chain. You've also got to show that the benefits of waiving CAS outweighs risk, and as you'll see later how there's so much interplay between CAS and FAR, that might be an easier thing to prove than it looks here in the statute. You can't have anything that could be obtained under the contract, if you basically just didn't even need the waiver. So there's got to be a purpose for granting the waiver. That's the only way they're going to get the property or services. So the agency's got to be able to make that argument. And also the price has to be able to be determinable, that it's fair and reasonable to the government without using cost accounting standards. So maybe there's a lot of data, a lot of transparency, a lot of comparable. There's some way to get around not having to use cost accounting standards. And that there's also a benefit to the government if they grant the waiver, which is typically getting something they can't get otherwise. Next slide, please. So the next section of 230.2 is basically the restriction on the military and the procurement and acquisition policy division that they can't allocate this CAS waiver authority. So it's set in stone. It has to stay at the very highest level. So it's either at the director of defense procurement or at the head of a military department. And then as to the $15 million contract limit, they anticipated people, say, issuing a mod later to get around that amount. So the military departments have to report any contract that's going to have a value over $15 million, where they've granted a waiver, and there's a mod or something that may have pushed it over the 15. So those things are tracked as well. So you can't bypass it by using mods. Next slide, please. So a waiver contains a lot of the things you would think How much is the contract worth? What's being purchased? What type of contract? Firm fixed, cost reimbursement. Are there any other CAS segments with this contractor that we're purchasing from as an agency? What will the contractor accept the contract if CAS applies? So I guess a better argument, if you're trying to get a waiver, if the contractor won't go any other way, or if you as a contractor aren't willing to take on the contract without the waiver from CAS, that's an important piece of evidence that needs to be in the waiver. If there's any certified cost or pricing data, how it's going to be used, the benefits to the government. This is the government benefit of waiving CAS, the risk of CAS, so that the department head or the director can make a decision on the potential benefit and risk to the government of waiving CAS. When does the waiver have to happen? So that sort of slots it in a timeline on how quick a decision needs to be made. And then any other useful information that might help bolster the cause to waive CAS. Next slide, please. So why do we have CAS in the first place? Basically, this is a project born out of Vice Admiral Rickover, a very famous admiral, probably credited with modernizing the U.S. Navy into the nuclear era. So he had a grand plan of buying lots of, let's say, carrier subs, anything to get the fleet stronger. And kind of what he noticed was it was very hard to get transparency, to see the cost, to compare offers, because one contractor would do it a unique way that maybe didn't make sense, and another contractor would do it another way, and you're trying to compare these two proposals that both have, say, overhead rates and G&A rates or other estimating factors, and there's no consistency to help you see which one is the better deal, although other than, say, the ultimate price. But in large purchases, it's often more complicated than just the bottom line. There's options, there's other add-ons. It's like buying a car. What option package is it cheaper to go this way? So a lot of those costs were impossible to evaluate. And so Admiral Rickover was testifying before a congressional committee with his, kind of his list of pet peeves on why we need accounting standards to cover basically Department of Defense contracting, and the accounting practices used to estimate proposals and create bills and accumulate costs. And he also had no confidence in anybody helping him except for Congress. He basically felt that the industry or the accounting profession were more gap focused, and this needed to be more on the cost accounting side. Next slide, please. So in 1968, we got the Defense Production Act Amendment. It's amending legislation that's been happening since the 50s. The new bill, basically the Senate's version, came in. The comptroller is now going to perform a study to see is it feasible in applying some sort of consistent cost accounting standards on all these defense contracts and subcontracts. Is that $2 billion that Vice Admiral Rickover thinks that we can save legitimate? Is there administrative burden to the contractors that won't outweigh the benefits to the government? And could it help the contractors as well to be consistent or have a set of rules to follow? Next slide, please. So 2 years later, the Comptroller General finishes their study and kind of found what you'd think, that it would be feasible to establish and apply some sort of cost accounting standards to give much more uniformity and consistency for negotiating and administering contracts. Prescribe some methods for computing types of costs, because we have, in the government contracting world, we're really concerned about direct costs, unallowable costs, indirect costs, indirect pools, things like that. Very common from contractor to contractor, and to have a common set of standards would help be able to compare from one proposal to another. And they came up with the cumulative benefit would outweigh the implementation and should be kind of compatible with GAAP to the extent it can be. And then the big thing was to establish a board to develop these standards and provide for the administration of the standards. Next slide, please. So in creating the board, it was part of Congress. So now it's CAS Board is part of the executive branch. When it was first established, it fell under the Comptroller General. who's under the purview of Congress. There's going to be a 5-member board, of which the comptroller was the chair. There was going to be 1 member from industry, 2 from the accounting profession, so I think professors and things like that, following kind of the GAP model of FASB back then. And then there's going to be 1 government agency or department head. So no specification on who or what. Their mission was to basically create these standards with the theme of creating uniformity of practices across contractors in similar circumstances, as well as time periods, so consistency from year to year. The overhead is computed the same way each year, and not necessarily computed with one base one year and another base another year. At the time, they was going to apply to 100,000 or more. This is 1970. I think now it's 500,000 or more. And then it also gave the exemption and waiver process to CASB, to the CAS Board, and then required disclosure in writing, which you've heard of, the disclosure statement, which I don't think the form, is still a typewriter form, so we're still following that old system. Next slide, please. So we have a CAS Board for a while. They developed the 19 CAS standards. They go out of business in 1980, but we still have the standards. They keep carrying on. Later on in 1988, Congress thinks it's a good idea to bring back the CAS Board. So the panel's reestablished. It's now under the executive branch where it is today, the Office of Federal Procurement Policy. The chair is the administrator of the OFPP. We have DCAA's director, so Defense Contract Audit has a person on the committee. There's an industry representative, the CFO of GSA. So GSA is buying lots and lots of things for the government, so they have the CFO on there as well. And then there's just 1 accounting member, so just 1 person from, say, universities and other more theoretical type applications of accounting. And at this time, CAS now applies to everybody, all federal agencies, not just Department of Defense. So it becomes a little bigger deal. Next slide. So everybody knows about FAR and CAS, and there are 2 sets of regulations. They kind of work together. They don't cover quite the same things, though there are elements of allocability in FAR. CAS is purely about allocability. You won't see anything about alcohol being unallowable. It's just where would you allocate it. Measurement is another big thing. Think of depreciation, class lives, and then pensions. The computation to determine your pension liabilities and such. Determination and treatment of costs, such as, is it an indirect cost, is it a direct cost? Are the costs assigned to the proper period? So very much, creating the annual period for overhead, pools, accumulating the costs and then applying to only that year. Keeping concepts similar from year to year. Whereas on the FAR side, we may refer to CAS in FAR, but it's typically to use its measurement or an allocability concept, but it isn't pulling you into CAS. So just because CAS is referred to in FAR, it's not really saying now you're CAS covered. It just sort of borrows from the CAS, because the CAS is much more detailed often than FAR is. Next slide, please. So if you search the internet, you may find tables similar to this one, different standards, but it's basically showing everywhere that FAR and CAS sort of cross-reference. So when we talk about consistency, we can see FAR 31201, and then we get CAS 401 and 402, very similar. So they're not going to be word for word the same. So for example, if we go to compensation, when it comes to deferred compensation, and you have, say, cliff vesting and things like that, well, CAS tells you how to, how to compute how much goes into each cost accounting period. FAR just says, go see CAS to compute how much is allocable to this year or to the current year and the future years based on the deferred compensation mechanism and vesting and things like that. Similar to pension liabilities, there's a small paragraph in FAR, and then it often refers you to the computations or the practice of CAS. Next slide, please. So this is FAR basically telling you that we may incorporate CAS, but we're not subjecting you to CAS. So we'll incorporate a measurement or an assignment or allocability rule, but the little allowability of costs is still subject to FAR. Only those portions that are specifically in there are mandatory. So unless your contract is CAS covered. So you may have a portion where under FAR you follow a certain rule, but then as soon as you become CAS covered, things are a little more precise, more technical, more rule, more regimented. Whereas in FAR, maybe you had a little flexibility. Now, if you're now subject to CAS, you had the same concept before in FAR, but it may be now it's a little more refined, a little more tougher, and that's one reason why some people go to find a waiver. Next slide, please. So you may have business units that are subject to standards, and multiple business units. Some are subject to CAS, some are not. And so FAR is basically telling you how do you, if you're subject to a certain CAS clause within FAR, and it's only for measurement purposes, then you're not pulling the whole business unit into the CAS world. And it's just really reinforced that FAR just incorporates CAS for its own use, but it's not subjecting you to full CAS coverage or modified CAS coverage. Next slide, please. So the cost accounting standards kind of have 6 general areas. We have like general standards, which apply to more general accounting kind of. We'll think of estimating and allocability, just very large, broad kind of standards. Not very technical, not very precise. Consistency standards, we're looking at, are we consistent from year to year? Is our practice consistent? Is our allocation consistent? Basically when you get to CAS, you can't change your practice without maybe a financial consequence. Now, if you're changing your cost accounting practice and there's no impact to the government, then the government will likely say, okay, that's good. But one reason to waive CAS is not to be subject to that sort of measurement or oversight. There's cost allocation standards. How do we allocate costs? Causal beneficial relationship between the pool and the base, and things like that are covered there. G&A and home office, how are they basically pushed down to the business units? Property standards are your tangible assets and capital assets, depreciation, capitalization. Compensation is covering all the compensation, I'll say, related to more the benefits. So things like pension and vacation and sick time and things like that, deferred compensation. Not executive compensation. That's an allowability issue, not necessarily an allocability issue. And cost of money, which is sort of like an interest replacement, has got a couple standards as well. Next slide, please. So in the general section, we have CAS 405 and 406, accounting for unallowable costs. This standard isn't telling you that a certain cost is not allowable. It's basically telling you to segregate, to identify, how you go about that, making sure that your unallawables don't get into the pool, directly associated unallowable costs. There's a lot more discussion here than there is in FAR. Cost accounting period is a pretty short one, but it's basically just defining what your cost accounting period, typically the same as the contractor's fiscal year, but there's also arrangements for when it may be different. Think mergers and acquisitions, buying another company who has a different fiscal year and somehow marrying up the two to the same cost accounting period. Next slide. Consistency, we have the 2 basic ones, 401 and 402, the first 2 standards. The first one really is making sure that you estimate in the same way that you accumulate and report. And a lot of people, you might see bid equals book equals bill. It's really kind of, if you bid, you can't do it in any more greater detail than you either book or bill a cost. CAS 402 is making sure that there's no double charging. This is really going to act if you have a cost, and it could be direct sometimes and indirect in other cases. There's a lot of illustrations, a lot of technical requirements in order to get this to work. if you do have a cost or a function that is, sometimes direct, sometimes indirect, as long as you have clear criteria, and CAS 402 can help you in that regard. Next slide, please. For cost allocation, we got basically the home office, G&A, basic one about indirect and direct. This is where we get into causal beneficial relationship between the pool and the base, and definition of a direct cost versus an indirect cost, very similar to FAR. So if you're already breaking up your costs by direct and indirect, this standard won't change a whole lot. And then IR&D, BMP costs, how do you account for those? Next slide. And we have the tangible personal or tangible property, capitalization, as well as depreciation. Very basic standards, pretty much follow kind of GAAP and stuff, and not IRS concepts. Next slide, please. We have the compensation standards, like I said before, compensation of personal absences. So how do you basically account for those, get them in the proper period? I would have, say, forfeiture of vacation, things like that, sick leave and all that, how to treat it, make sure it's in the right cost accounting period. Pension has several on how to basically measure the pension costs and charge them to the right period as well. And the same for deferred compensation, like in the example I gave earlier, where depending on your vesting, you may not get deferred compensation in the years you thought you were getting it. There's a little measurement device as well to make sure you allocate it to the proper years. Next slide, please. Cost of money has a couple of standards, one having to do with when you're constructing an asset, and the other one basically just the computation of cost of money. It's basically an interest kind of replacement. Interest is allowable in FAR, so this is a way that the government is given to incent a contractor to improve capital and maybe get some sort of financing, though it's a very low interest rate. And unless you have a lot of dollars, a very big, a lot of work to get a little bit. Next slide, please. So modified CAS. This is when you're only subject to a few standards. It's when your awards are between $7.5 to $50 million. And so as we noticed with one of the waivers, if it was under $15 million, you could get a waiver. Well, what am I waiving if I'm under $15 million? Well, I'm probably trying to waive to not be covered by modified CAS. So then I'm worried about 401, 402, 405, and 406, with 405 being unallowables, 406 being cost accounting period. So it's really more of an estimating and consistency sort of issue than, say, unallowables or a cost. It could be a cost accounting period issue, especially if a merger has occurred or something, and maybe the CAS waiver is necessary to basically mitigate that issue. A disclosure statement isn't usually required for modified CAS. It's below the 50 million threshold, though there are contracting officers that may make it required as part of the contract. Modified CAS coverage, because CAS coverage applies to a contract, so long as that contract is around, it's always modified CAS, even if you move into full CAS. Next slide, please. So the first one is CAS 401. The purpose is to make sure that the contractor's practices for estimating are consistent with the accumulating and reporting. Basically, the estimate book equals bill. We want them comparable because the government is tracking on one side to what your original proposal was to make sure they match up. Next slide, please. So ultimately, it's for better proposals. It comes down to estimating practices. Are the estimating practices in more detail than what you could determine from the accounting records? So they're basically looking, I won't say like made up numbers, but numbers that probably don't have a good support or basis because they're in more detail that can be extracted from either accounting records or other supporting records. Next slide, please. So you you aren't prohibited from accumulating or reporting in extreme detail. So if you wanted to record every screw into your ledgers or your accounting records, you could. It's not preventing any of that. It's just preventing you from estimating by, say, in this example, hinges, wood, and brackets. If you don't break it out in your accounting records, then you really can't say it takes 6 hinges or it takes 8 linear feet of wood or however many brackets. It may be because of the way that you accumulate your costs and say very large invoices with no detail. It just goes in as material. That the best you can do is say, well, about 45% is direct material and the remaining is indirect and supplies, because that's how it's tracked. Alternatively, if your hinges and screws and woods were somehow broken out in your accounting records where you could estimate in that sort of detail, then basically your bill of materials or your other estimating factors could be based on that extreme detail and have support for the amounts. Next slide, please. So the purpose on the reporting side is kind of a budget to actual analysis that all contracts are typically held to. There's performance reports that are done. There's billing that's done. There may be milestones. So if you get a contract, it's often the actuals are compared to what was estimated, and that's kind of how they fund the contract as well. What was estimated. If the government can't track or follow with the actuals as they're recorded in the accounting system to the proposal in any way, then you can have a CAS non-compliance because you didn't estimate the same way that you reported or estimate the same way that you accumulate. So it can have a little different flavor after you get the contract. Next slide, please. So another degree of consistency would become in say the classification of how you determine something indirect or direct. So if in the estimate or the proposal you propose a certain cost as direct because this contract was going to pay for it, but in the prior 50 proposals you'd always used it as indirect, and your books and records were in such a fashion that you couldn't distinguish, you would run into a non-compliance that way. That would be a consistency when it has to do with how the proposal had costs classified versus how they're actually recorded. Same thing when it comes to, say, an indirect pool. If it's proposed one way, but then in real life, the way it's accumulated, the way it's applied, say in billing as well, in a different way from the proposal, you can run into a CAS 401 violation as well. And then also the way you may allocate it to the contract. The base may have been direct labor, but for this contract, the estimate showed it was going to be the overhead was going to be applied to direct labor and fringe benefits, or something. Just a different base was used in the estimate or in the proposal than is actually used in real life. Next slide, please. So for the first illustration, we have a proposal using direct labor rates that are, say, category averages. So think, engineering 1 has an average of $50 an hour. Engineering 2 has an average of $75 an hour. So that sort of concept where you're grouping employees and then bidding them as a labor mix based on those categories. So that's basically a compliant way of doing it. You're estimating in average direct rates. You accumulate at the employee's actual costs, and you actually bill at the actual cost as well. So your estimate is actually in less detail than how it's accumulated or reported. Next slide, please. So here's a more classic one. You have travel. You've always done it as an indirect cost. A contract comes around that's going to pay for your travel, or this contract has a lot of travel that's direct. So now it's like, we need to bid our costs for direct travel. So now we're basically bidding in a different way that we actually accumulate. So if we don't change our practices, then our disclosed practice has, travel costs have always been indirect. However, in this proposal, we're going to bid direct, and that's going to be non-compliant with CAS unless we change our accounting practice. And if you're subject to CAS, if you're changing the CAS accounting practice, then you have to go basically evaluate it and determine if there's any cost impact to the government on all the affected contracts. So it could cost money or save money to the government. And whether they approve the change or that is a huge topic. I can do seminars on that just alone. But that's one reason why people would want to waive CAS. Next slide, please. So next we move on to CAS 402. This is sort of the double charge CAS accounting standard. It requires that every cost only be allocated one time. So that's where you get into, is the cost always direct? Is the cost always indirect? Or is it a hybrid of the two? And if it's a hybrid of the two, are there criteria that will prevent basically a cost only being allocated one time? Next slide. So as I said, this is pretty much the guard against overcharging. It occurs typically when you have a cost that is also added direct, but that cost is still included in, say, in indirect. So think of our travel. If all that direct travel was still kept in the pool and charged as indirect travel, then that contract would have double charging, because you'd have your direct charge travel, and then you'd have an allocation of overhead that has both the indirect travel and the direct travel being applied. So that same direct travel would be costed twice to the contract. So it's important to make sure you establish your practice to prevent the double counting, because that's what the government will focus on. Is this cost that's sometimes direct, sometimes indirect? Is it somehow being billed to me twice? Is what the contracting officer often asks. Next slide, please. So here's kind of an illustration of this concept in not so many words, but it's the kind of the flow that you would go through. So you have costs that are incurred for the same purpose, so they're supposed to either be direct or indirect with respect to their final destination, their final cost objective. So what you have to get into, what's the purpose and circumstance for incurring these costs. Now, something like travel, it may be pretty easy to establish criteria. If it's direct travel because it's directly attributable to the contract, you have an employee charging time to the contract during that time. There's a lot of evidence to show that it's direct for that cost objective. And on the indirect side, you can see maybe the travel is always for training and such. So you could, it's travel. It's both indirect and direct, but there is a way of defining when it is direct and when it's indirect to prevent it from being double charged. So, like in the illustration, you've got the oval and the square, keeping everything kind of separate, so that costs are only allocated once to our cost objectives X, Y, and Z. Next slide, please. This is kind of an illustration, a further illustration of what you might do when you have a change like we talked about with travel. So we'll think about with planning costs. We have the contractor, we normally allocate our planning costs indirect over direct labor hours. So it's kind of an overhead expense. Now we have a proposal that's going to use a lot of planning costs. And so we know, based on the current allocation, it's going to create an overuse by one firm, but not getting charged for the full use of it, because the costs are being applied by direct labor hours, and there may be lots and lots of planning done. So then it may be a change in the base. So, for example, instead of using direct labor hours, maybe we use the planner's labor hours. So how many hours did the planner charge to this contract? And that would have a way of allocating planning costs that was basically caused by the planning labor. So you've got a good causal beneficial relationship between the pool and the base. Number of planning documents. In the old days, it may have been how many drawings, things like that. might be one way. So you can use an activity-based measure as well. Sometimes you see that in IT. How many computers? The more computers, the more IT issues, or the more IT resources used. So things like that. Sometimes from changing from a simple direct labor to more activity-based, or something with a more direct relationship, will improve your situation and be CAS compliant. Next slide, please. And so kind of speaking of IT, we have a contract that has kind of two types of IT. You've got general help IT, and then maybe you've got some more dedicated 24-hour. You see this with security. You have regular security, and then also you have special security for this contract. So the same kind of thing you'll get into. Well, we can't have double counting. Do we have two different functions? Is there a way we can make sure that the right resource goes to the right place in the right allocation? So it may be that we'll have some general IT, because that applies to everybody, but maybe these people who do the special are carved out of that IT help desk pool. And similar with the planning, we're only allocating it when they charge their time and where they charge their time to. So they've been eliminated from that help desk pool so that we don't get a double charge. Next slide, please. So CAS 405 is dealing with unallowables, but it's not telling you lobby costs are unallowable, certain legal expenses are unallowable, or alcohol is unallowable. It's basically telling you that you have to have, how to identify or ways to identify costs that are unallowable, and how to treat the unallowable costs, basically how to allocate them so that they're consistent from a cost objective to cost objective. Next slide, please. So you always hear about the segregation of unallowable costs and the identification. And CAS 405 is sort of where you can go to kind of get a little bit of help on that. You can have unallowable costs, either due to the regulations like FAR 31205 says this is unallowable, or it's unallowable in these cases. You can have a contract that says it as well. So you can have a contract that has maybe something that was allowable, but in this case it's going to be unallowable. A lot of times you have compensation caps, things like that. Might be contract specific. And so how to treat those the same way as a regular unallowable cost is sort of covered in the standard as well. Like I said, it's not governing unallowability. It's mostly focusing on allocability and accounting for it. Next slide, please. So in CAS 405, there's a lot of discussion about directly associated costs. And a directly associated cost is typically a cost that is maybe allowable by itself, but because it's directly associated with an unallowable, it becomes an unallowable cost. And so you got to be careful on treating those costs because they may have to stay in their base, especially if they're labor. They might be unallowable labor, but if it's direct labor, that's your overhead base, you may have some unallowable direct labor on the contract that you don't get billed for. But when it comes to computing your overhead rate, that associated direct labor that's unallowable is still going to stay in that base. And that's so that all the costs basically receive their fair share of overhead. So when you have a directly associated cost, it gets a little more complicated on where is it unallowable, where is it, I guess, when I say unallowable, where is it pulled out and where is it left in? So it may be pulled out on the billing side, but left in when it comes to computing the rate. And that's just to make sure everybody gets their fair share, no matter if you're allowable or unallowable. Next slide, please. So there's nothing on exactly what you need to do to show you have support for whether a cost is unallowable or not. It basically needs to be adequate enough to basically have some visibility to what's unallowable, including the directly associated. So if you have a restaurant certificate in expense report, then you can see, oh, there's alcohol. It's probably a line item on the bill. So that would be adequate enough to show that, that's the unallowable cost, and you were able to segregate it in your accounting records because of that evidence. If it was just a one-line, here's a restaurant bill for so-and-so, where you couldn't determine the unallowed, which part was alcohol, or if there was alcohol, nor could you prove that there was no alcohol. For example, if you're purchasing food at, say, a bar or something like that, which is generally there to sell alcohol rather than food. So then you're, say, maybe battling with the auditor on, well, you don't know how much, so we're going to question the whole thing. So this is basically setting a standard to make sure that you establish and maintain your visibility to those unallowable costs so that you can prove them one way or the other the actual amount. It doesn't need to be, detailed inside the accounting records, but like in the restaurant example, it could be on the actual expense report or the receipt, the supporting documentation. Next slide, please. So in CAS 405, we have three options called the visibility requirements. You can segregate unallowable costs in separate accounts. So oftentimes that's done. Interest is a good one. Bad debt expense, another one that typically has its own account. Anything in there is unallowable. 100%, basically call them 100% unallowable accounts. Some people break out travel so much that they have a travel that's just for unallowable. Or you can have separate accounting records or work papers. Maybe there's there's a split done at the personal expense level. Alcohol goes to a certain account for unallowable. The rest of the restaurant tab goes to the meals account. So you're using maybe a different format to get and show some identification and show the segregation and basically give a paper trail of the unallowable amount. And then even more informal ways. Just if you can basically audit it, then it's typically okay. And you'll see probably all three at a company because it's easy to set up an interest and a bad debt expense account. Then the next step is, okay, it's easy to have Concur software or something on the travel side automatically as the employees inputting their travel expenses, route the accounts, route the allowable costs to the proper place. And then sometimes for a larger event or function, or say for legal expense, it takes a little more where you've got to go in and read the bills or the invoices, and then you have a separate record of maybe of the computation that's kept in the file for audit reference. Next slide, please. The CAS 406 only talks about cost accounting period, fairly short. It gives the examples of when fiscal years basically could be different and from a cost accounting period. Like I said, a lot of times it's an M&A activity. Other times it may be in the old days when you had tax reasons to do a fiscal year a little differently than another period for accounting purposes. But a lot of that is now changed. There's two criteria. Basically, your expenses must be identified with that period in some way, and it needs to still be annual. So you're not getting away from a 12-month period, though short periods like an M&A or you're moving to a new accounting period definition, like going from a government fiscal year to a calendar year. So going from an October 1 to September 30 to just the plain calendar, you'll have a short year or a long year, and need to work that out with the contracting officer. But it may be, the purpose is to unify cost accounting periods because of M&A activity. So you need to still follow the same accounting processes that you have for your accruals and adjustments and deferrals. So it doesn't matter that now the time frame isn't a calendar year or it's different. You have a calendar year for your financial, and your cost accounting is a government accounting, because it's a little easier for certain contract to run that way. As long as you're following the same rules for both, you can get a different cost accounting period justified. Next slide, please. So there are certain exceptions. You may have a function that only occurs part of an accounting period, so it's not a cost that happens all year long. And so if creating this off period takes advantage of that to where it, say, maybe shoves more of that cost to government contracts, you're not likely to get that. You may have, like I said, with M&A activity, you have change in fiscal years, and so there may be some workout that needs to be done. And if the contractor and the government agree on using a certain period because of the way the contract is, then that's okay as well. So you're not burdened by CAS 406 in that case, because you have you're agreeing with the government to do it this way. You'll see that more in maybe a teaming arrangement where two companies have different fiscal years, and the special purpose entity that's running the contract, or the JV, is going to have a cost accounting period different than one of the partners. So there's ways to make things work. CAS 406 is kind of there and sort of gives you the guidance for those situations that come up. Next slide, please. So once you have a cost accounting period, you need to use that same period for all your indirect rate cost pools and bases. So, I mean, it's kind of obvious that if each pool of base had different years, they wouldn't ever match up right and be able to fairly allocate costs. And so everything uses that same accounting period. You can use a period when it's a little different is, we'll say, there's administrative convenience, like terminating of a function or something like that, and say the practice is always consistently followed. So like during a restructure or something disappears, it may not make sense to use a full cost accounting period for that particular allocation. But so it's anytime you get used playing with the cost accounting period, or a shortening or a lengthening due to M&A work, or a downturn or upturn or new contracts, one place to go is the CAS 406 and see if that will impact anything that you're doing, or if there's an easier way to do it. Next slide, please. So an annual period that's representative is basically the one that we're going to use for our cost accounting period. It's how all the indirect costs are allocated and accumulated. So we use it basically to define the rate. We define how we record costs, and we also allocate. So we accumulate and allocate all in that same annual period, whatever it may be. As long as it's not materially different. So if you're changing from, say, the government fiscal year to the calendar year, if there's no material difference, because maybe your costs are so even, it doesn't matter. There is no spike that might go to one contract or another because it's ending right before this change or something like that, and there's no material difference. If you can show that, then it's also pretty easy to change your cost accounting period to be something different. Next slide, please. And I believe that's the end. So I thank you very much.
Thank you, Robert, for a great presentation and for sharing your time with us today. And for anyone that has questions, feel free to contact Robert using the information on your screen right now. And thank you to everyone who joined us for this webinar. The recording will be on our website and YouTube channel within the next 24 hours. And please join us next week as we cover more parts of the DFARS. Have a good one, everyone.